We all put so much effort into planning for the future, don't we? I mean, you work hard, you save, you set up those retirement accounts, maybe draft an estate plan.
Absolutely. It's a huge undertaking.
You've got this vision for your legacy, how things will support your family down the line.
Right. You get all the pieces in place, make sure your intentions are crystal clear.
But what if all that careful planning, stuff you thought was locked down, could just be, well, undermined quietly by laws changing that maybe you didn't even hear about?
That's the scary part.
Okay, so let's unpack this.
Yeah.
Today, we are diving deep into some really significant changes. Honestly, often overlooked changes that have just reshaped retirement and estate planning.
Yeah.
We're talking about the Secure Act from 2019, Secure 2.0 in 2022, and these really critical IRS regulations finalized just this past July 2024.
And these aren't small tweaks.
No, not at all. Fundamental shifts.
And that's really our mission here today for you listening. We want you to grasp why these updates matter so much, especially if your plans, your IRA beneficiaries, your trusts, were set up before 2019.
Because those old plans might not work anymore.
Exactly. The reality is these changes can basically invalidate older strategies. They can lead to, well, much higher taxes than you ever planned for, force withdrawals much faster than intended.
Which could trigger penalties too.
Oh, definitely penalties. Or just distributions that don't match your goals anymore, like, minimizing taxes for your kids or protecting assets for someone vulnerable. Your whole plan could be compromised if you're not up to speed.
Yeah, you're spot on. This isn't just, I need to update a form.
Yeah.
It's really about reevaluating your whole strategy, making sure your goals aren't going off the rails. We've got some surprising facts coming up, definitely some aha moments that might make you really rethink things, maybe even feel a little urgency.
Hopefully in a productive way.
Right. So let's start with maybe the biggest one, the most impactful change. The end of the Stretch IRA for most people who inherit one.
Ah, yes, a stretch.
Yeah, if you've done estate planning, you probably remember the old way. Non-spouse beneficiaries, like kids or grandkids, could stretch those IRA withdrawals out for a really long time.
That's right. Under the old rules, pre-Secure Act, they could spread the RMDs, the required minimum distributions, over their own life expectancy.
Which could be decades.
Decades, easily. 50, 60 years, sometimes more. It was this amazing tool for tax-deferred growth, kind of a cornerstone of multi-generational planning.
What changed?
So the Secure Act, for anyone who died after December 31st, 2019, basically wiped that out for most non-spouse heirs and replaced it with the 10-year rule.
The 10-year rule, okay.
Meaning now the entire inherited account has to be completely withdrawn, emptied out by the end of the 10th year after the original owner's death.
Wow, okay. 10 years versus potentially 60.
It's a massive difference. And what's really fascinating or maybe alarming is how this just makes so many old plans obsolete.
How so? Like, give us an example.
Okay, think about someone, let's call her Sarah. She set up her plan in, say, 2018. Her goal was simple. Her grandkids inherit her IRA. It grows tax-deferred for decades, giving them a huge leg up.
A common goal.
Very common. But now, that plan doesn't work. The grandkids face this compressed 10-year timeline. Instead of slow, steady growth, they might get hit with huge distributions that push them into way higher tax brackets.
So the tax hit is much bigger, much sooner.
Much bigger. We could be talking up to 37% federal income tax plus state tax on top of that. For a big IRA, heirs could lose 40, maybe even 50% to taxes if the plan isn't adjusted. It's staggering.
That's a huge chunk gone. So if your whole strategy was built around that long-term growth for younger heirs, that's just gone.
Pretty much, yeah. That specific goal might just not be achievable anymore with an IRA structured the old way. It forces a much faster drawdown.
Now, you said most beneficiaries. Are there exceptions?
Yes, there are important exceptions. They're called eligible designated beneficiaries, or EDBs. This group includes surviving spouses, the owner's minor children, but only until they turn 21. That's key.
Oh, okay.
Disabled individuals, chronically ill individuals, and interestingly, anyone not more than 10 years younger than the original owner. Maybe a sibling, for instance.
So those specific people can still stretch.
They can still use the old life expectancy rules, yes. But for everyone else, adult children, grandchildren over 21, friends, other relatives, it's the 10-year rule. It's like the rules just changed mid-game for a lot of families.
It really does sound like it.
Yeah.
And just when we thought we understood the 10-year rule.
Uh-oh.
Right. It got another update, a really critical one from those recent IRS regulations. I admit, when I first heard 10-year rule, I kind of pictured flexibility. Maybe take it all in year 10 or spread it out however you want within the decade.
That was a very common assumption.
But these new rules, they changed that understanding, didn't they?
Huh.
What did the IRS clarify?
That's a great point. And yeah, this is where it gets really interesting and frankly tripped a lot of people up. The misconception was exactly that. Flexibility within the 10 years. Wait till you're 10, maybe take it all then.
Right.
But the IRS's final regulations, effective for distributions starting in 2025, they clarified something crucial. If the original owner, the person who died, was already taking RMDs.
Meaning they were over the age threshold, like 73 or 75.
Exactly. If they had reached their required beginning date and were taking those mandatory withdrawals, then the non-eligible beneficiaries inheriting the account must also take annual RMDs during years 1 through 9 of that 10-year period.
Wait, so you can't just wait until year 10?
Nope. You have to keep taking withdrawals based essentially on the beneficiary's life expectancy calculation within those 10 years, often using the old calculation methods just for those annual amounts, and then empty the rest by the end of year 10. It's tied to this concept called the at least as rapidly rule.
Okay, that sounds way more complex.
It is, and the impact is huge. It forces taxes earlier, depletes the account faster than many plans expected.
So if Dad was taking $20,000 a year out,
then the kids inheriting, if they aren't EDBs, likely have to take at least a certain calculated RMD amount each year for those first 9 years, and then whatever's left by year 10.
and if they miss one of those yearly RMDs,
That's the kicker. Starting in 2025, the penalty for missing an RMD could be up to 25% of the amount you should have taken out.
25%, wow.
Yeah. The IRS gave relief for 2021 through 2024 because there was so much confusion, but that relief ends. So this becomes a big deal, especially if the IRA was supposed to fund a trust or be part of a multi-generational plan. Missed RMDs could mean audits, penalties, really eroding the legacy. It's not a flexible decade anymore for many.
Okay, so that's a major heads up for beneficiaries. But let's shift back to the account owner. These Secure Acts also change things for you directly, right? Like when you have to start taking money out and when you can put more in.
Absolutely, and those changes ripple through the whole plan.
So what changed for the owner's RMDs?
Well, first, the original Secure Act pushed the start age for RMDs from 70.5 up to 72.
Okay, a slight delay.
Then Secure 2.0 pushed it even further. If you were born between 1951 and 1959, your RMD age is now 73.
Got it.
And if you were born 1960 or later, your RMD age will be 75, though that kicks in starting in 2033.
So people get more time before they have to withdraw.
Exactly. More potential years for tax-deferred growth for yourself. And on the flip side, the contribution rules change too. Before, you couldn't contribute to a traditional IRA after age 70.5.
Right, I remember that.
That limit's gone. You can keep contributing as long as you have earned income. Plus, they introduced higher catch-up contribution limits. Starting in 2025, for instance, people aged 60 to 63 might be able to contribute an extra $10,000 or 150% of the standard catch-up to their workplace plans.
Oh, that's significant. A chance to really boost savings later on.
It's a powerful tool, especially when income might be peaking before retirement.
So, tying this back, why does this make older plans obsolete? It sounds like delaying RMDs is good for the owner, but you hinted it might be tricky for heirs.
It definitely can be a double-edged sword. First, if your old plan documents, maybe a trust, specifically said start distributions at 70.5, well, that's now outdated. You could be forcing distributions and taxes earlier than needed under current law.
Okay, creating unnecessary tax bills.
Right. And then from the heir's perspective, if you delay your RMDs, your IRA is likely going to be larger when you pass away.
Makes sense. More growth time.
But combine that larger balance with the 10-year rule for your non-EDD heirs. They now have to withdraw a bigger amount in that compressed 10-year window, which likely means an even bigger tax hit for them.
I see. The delayed RMD amplifies the 10-year rule problem.
Exactly. Plus, if your strategy isn't updated, you might just miss those opportunities for extra growth yourself, or miss making those higher catch-up contributions you're now eligible for. It's about optimizing the whole picture.
Okay, this leads perfectly into talking about specific tools, like trusts, and that thing you mentioned, beneficiary designations. You called it a wormhole. That sounds ominous.
It can be. Let's talk trusts first. Many older estate plans use trusts, often conduit or accumulation trusts, to hold inherited IRAs.
What's the difference, quickly?
Sure, a conduit trust generally passes IRA distributions directly out to the beneficiary relatively quickly. An accumulation trust can hold on to those distributions inside the trust, maybe for asset protection or if the beneficiary is young or has special needs.
Okay.
But both types were usually designed assuming the trust could stretch those IRA distributions over the beneficiary's lifetime using the old Stretch IRA rules.
And now with the 10-year rule.
It blows up that structure. The trust might be forced to distribute huge amounts very quickly to comply with the 10-year payout.
And what problems does that cause?
Well, think about it. If a large sum suddenly gets paid out to a beneficiary who relies on needs-based government benefits, like disability, that payout could disqualify them.
Oh, wow. A terrible unintended consequence.
Exactly. Or if the trust was meant to protect assets from creditors or maybe a divorce, pushing all that money out quickly could expose it. The protection disappears.
And there's more with trusts.
Right.
Something about see-through status.
Yes, that's critical. For a trust inheriting an IRA to even get the 10-year rule, it generally has to meet specific IRS requirements to be considered a see-through trust. If an older trust document doesn't meet these, perhaps because of how beneficiaries are defined or how distributions are mandated,
Then what happens? Not even 10 years.
it could be worse. The trust might be subject to the rules for non-designated beneficiaries, potentially forcing the entire IRA to be paid out within just 5 years of the owner's death if the owner died before their RMD start date. Even faster depletion, even worse tax outcome.
Okay, so trusts definitely need a review. Now back to that wormhole, the beneficiary forms.
Right. This is such a common, dangerous mistake. The beneficiary designation form, the one you fill out with your bank or brokerage for your IRA, your 401k, life insurance.
Yeah.
That form overrides your will. It overrides your trust usually. It's a direct contract.
So even if my will says my IRA goes to my kids.
If your beneficiary form still lists your ex-spouse from 20 years ago, guess who gets the IRA?
The ex-spouse. Oh, boy.
Exactly. And since IRAs are often people's single largest asset, having an outdated beneficiary form can completely derail your entire estate plan, sending that wealth to the wrong person, bypassing all the careful planning and protections you set up in your will or trust. It's a silent plan killer.
That really is a wormhole.
Yeah.
Okay, putting all these pieces together, the 10-year rule, the RMD changes, the trust issues, the beneficiary forms, this paints a bigger picture, doesn't it? Especially concerning estate taxes.
It really does. If you step back, what these acts signal is a pretty clear policy shift from the government.
How so?
Well, they're effectively discouraging the use of retirement accounts as multi-generational wealth transfer tools, as long-term tax shelters. The message seems to be, these are primarily for your retirement. The days of easily passing massive tax deferral down the line are largely over.
Making them more like personal savings accounts in the end.
In a way, yes, at least in terms of inheritance rules for many. Now, connect that thinking to what's happening with the estate tax exemption, the Tax Cuts and Jobs Act, the TCJA from 2017.
Yeah.
A big chunk of it is set to expire to sunset at the end of 2025. Unless Congress acts, the federal estate tax exemption, which is currently very high, over $13 million per person in 2024.
It's going down.
It's scheduled to be cut roughly in half, back down to around $7 million per person, adjusted for inflation starting in 2026.
Okay. So how does that connect to the IRA changes?
Think about it. Your R&Ds are delayed, so your IRA balance is likely larger when you pass away. Then, that larger balance faces a much lower estate tax exemption in 2026 and beyond.
So more of that bigger IRA could suddenly be subject to estate tax.
Exactly. You could face a potential 40% federal estate tax hit on that larger IRA value before your heirs even get it. And then they still have to pay income tax on the withdrawals under the 10-year rule.
Wow, that's a double whammy. Estate tax and income tax.
It's a serious compounding problem. Unchanged plans could see a huge portion of that retirement legacy just evaporate due to taxes. Proactive planning is absolutely essential to navigate this.
Okay, so let's wrap this up. The big takeaway here seems crystal clear. These are not small changes. They fundamentally change how retirement money is passed down and taxed.
Totally.
And they could seriously derail your goals if you're not paying attention. So the bottom line message is, if your plans, your will, your trust, your beneficiary forms were set up before, say, 2020,
you almost certainly need to take action.
Right.
So to avoid your plan becoming obsolete, here are some concrete things you, the listener, should really consider doing, like today.
Okay, let's hear them.
First, and this is non-negotiable, talk to a qualified professional, a financial advisor, an estate planning attorney who is specifically knowledgeable about the Secure Acts and these new IRS rules. Not everyone is up to speed.
Good point. Find someone who knows this stuff cold.
Second, pull out those beneficiary designation forms. For all your accounts, IRAs, 401ks, life insurance, everything, review them, update them, make sure they match your current wishes and your overall estate plan. Avoid that wormhole.
Okay, check the forms. What else?
Third, think about Roth conversions. This means paying income tax now to move money from a traditional IRA or 401k to a Roth account. Why? Roth IRAs don't have RMDs for the owner or for the beneficiaries, and withdrawals for heirs are tax-free. It can solve the 10-year rule tax problem for them.
So pay tax now to avoid potentially higher taxes for heirs later.
Exactly. Fourth, if you have trusts designed to hold retirement assets, they absolutely need to be reviewed and likely updated. Make sure they explicitly address the 10-year rule and still qualify as see-through trusts, especially if protecting vulnerable beneficiaries is a goal.
Don't assume your old trust works.
Definitely not. And finally, maybe explore other strategies. Things like charitable remainder trusts could be an option, especially if you have charitable goals. They can offer tax benefits and bypass some of these IRA inheritance issues.
Lots of options, but they require action.
And urgency. I have to stress this again. Starting in 2025, those penalties for missing the newly clarified annual RMDs under the 10-year rule kick in. Ignorance won't be an excuse. Getting ahead of this now is really crucial.
That's a powerful, practical roadmap. And maybe a final thought for everyone listening, building on all this. Are your retirement accounts really set up the way you intend? Is that lasting, tax-smart gift? Or could they accidentally become this unexpected tax nightmare for your loved ones because of rules that changed under the radar?
It's a crucial question to ask yourself.
So think about the steps you can take, starting today, to make sure the legacy you worked so hard for actually ends up looking the way you planned.